Welcome to Markets in a Minute. My name is Austin Duke. I am financial advisor and chief investment officer for Diamondback Financial Services. We are an investment advisory firm focused on clients who recognize the need for solid investment advice, who don't want to invest on their own, but still want to be educated through the process. This is the Monday, June 23rd, 2025 edition. Let's get started. All right, we'll start by looking at the stock market as measured by the S&P 500. This is an index of the 500 largest companies in America. Stocks will go up and down on a daily basis for a variety of reasons, and our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. The prior 2-week period, we did have a federal holiday on June 19th, so this is only 9 days of actual trading for the last 2 weeks, but a total return of negative 0.54% for the 2-week period. That brings our year-to-date gain down to 1.47%. Next, we'll look at interest rates as measured by bonds issued through the U.S. Treasury Department. Interest rates are factored into every investment calculation, every valuation, including stock valuations. And generally speaking, lower interest rates will lead to higher stock prices. Higher interest rates will lead to lower stock prices. And our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. So this is interest rates listed over on the left-hand side, maturity lengths listed on the bottom from 1 month all the way out to 30 years. Green line is where we ended on Friday, June 20th, and the brown line is where we were 2 weeks ago. For the most part, we saw interest rates, medium and long-term rates come down. That was mostly in response to Israel and Iran exchanging missiles. We usually will see a flight to safety, and bonds are usually seen as pretty safe investments. So as those bonds get purchased, interest rates will go down as a result. We did have a little bit of an anomaly here on the 2-month rate going up. The Federal Reserve met and concluded their meeting on Wednesday and left the Fed funds rate unchanged, which leads us to believe that it'll probably still be a couple months before we see that first interest rate decline, at which point these rates should all shift lower. Okay, it feels like forever ago, but we started the 2-week period on a high note after the US and China met again to discuss tariffs and trade deals. Positive news came out of that meeting, and the stock market rose to begin the 2-week period. Our U.S. Treasury Secretary Scott Bessent was the one who reported that things were moving in the right direction. There's also speculation that he could be somebody that President Trump nominates to replace Jerome Powell on the Federal Reserve, chairman of the board. We like Mr. Bessent where he is. We think he would do great at the Federal Reserve as well, but we also like what he's doing for the trade negotiations. I think the news that dominated the headlines over the past week, obviously, is Israel and Iran engaged in a conflict and exchanging missiles. And we had President Trump attending a G7 meeting and leaving early, presumably to deal with that conflict. Whether or not the U.S. gets directly involved remains to be seen. But the market declined over the past week, we believe mostly because of the tensions in the Middle East and the potential for the U.S. to be involved more than we have been. In true President Trump fashion, instead of just making a decision and either doing military action or not, he has given us a 2-week delay on whether or not he's going to do that. I mean, he's been in office now for 5 months. I can still remember the TikTok deal, or how that app got shut down and then he brought it back a day later. The tariffs went through and then he called them off a day later. This is just the recurring theme, and I keep getting sucked into the whole back and forth that goes on. But I think if we hear something, we just need to take it with a grain of salt and just realize that it's going to be weeks, months before it actually plays out. And even then, who knows? Anyway, there was something that came up this past week. There's an idea of opening up an account for each child born in America and putting $1,000 into those accounts to be invested in the stock market. Which I don't know if it would be for retirement or college or what the purpose is, but it would give these kids some opportunity to invest and have money down the road for something. If we were to assume it's a retirement account and we use the full retirement age today of 67, and we average a 9% growth rate in the stock market, that $1,000 would turn into over $321,000 if nothing else was added to it. So it's something we've heard before. We think it's a good idea. It's interesting. We know that not everybody has that opportunity to open up accounts for their kids and put money in, but it could be very interesting for the future of our country if we were able to do that. Also, we like when money goes into the stock market because then that tends to lead to higher stock prices. So, um, the Federal Reserve met and concluded their meeting on Wednesday. No changes to interest rates. We think that there's sufficient evidence for them to cut rates, and they haven't done it. So we think they're going to be playing catch up. We think they're behind the curve. And come July or September, we think they're going to potentially be cutting by 0.5% instead of doing 0.25% now and then doing it again in July or September. But we're not in charge, so we'll wait and see what happens there. Also, finally, a couple days ago, there's a Japanese investment firm called SoftBank, and they are pitching a $1 trillion industrial complex in Arizona that would build robots, artificial intelligence, really bring high-tech manufacturing back to the United States to rival what they have in China. Still very preliminary stages, but that would by far be the largest investment in America ever. As far as the economy is concerned, let me pull up what I've got here. We had inflation readings. So, consumer price index, the CPI inflation came in at a 2.4% headline. It was 0.1% month over month. And if we look at the last 3 months annualized, it's only a 1% interest rate. Now, Federal Reserve told us they were looking at 2%. And assuming that things continue the way they have been, we would be below 2%, which is why I think a decline in the Fed funds rate of 0.25% would have been justified this last week, but I digress. Producer price index, this is a wholesale inflation reading that came in at 2.6%, also was up 0.1% month over month. We had retail sales were down 0.9% for the month, which we think there was a lot of purchasing going on back here in March ahead of the tariffs that we were anticipating. So, for example, a lot of cars were purchased ahead of the reading, and not as many cars were purchased in May. So, if we had pulled forward all of those retail sales early in the early months ahead of the tariffs, then it would make sense that we would see a decline in retail sales. Also, jobless claims, we saw them tick up a little bit here in the first couple months, but that's not unusual to see, right? We go from May into June and we see an increase. We've seen that again year over year. So, uh, not seeing anything completely out of the ordinary, right? Nothing glaringly obvious that would suggest that we are in a bad spot. But yeah, jobless claims, continuing claims, the employment situation looks just fine. The housing situation still a problem. Mortgage applications are down. Housing starts, building permits are all down. Building completions are up. So it feels like the developers are focused on getting those projects that they have completed and sold so they can collect some money, stay in business. But if we don't have more activity pick up, we don't have more permits filed and more houses started, then we're going to have a similar issue down the road. So, lower interest rates would go a long way to helping that out. All right, as far as our expectations and implications portion, we came across this table over the last couple of weeks, and what we're trying to identify is what effect, if any, do geopolitical and other major historical events have on stock market performance? And even though we've got a lot of events listed here and we've got performance of the stock market 1 month, 3, 6, 12 months into the future, there's still some debate as to whether or not these events resulted in the stock market actually performing the way that it did. But we've got World War II events, Korean War, the oil embargo back in the 70s, and presidential assassinations or attempts. We've got the stock market crash of 87, some financial crisis era issues, et cetera. So, by and large, there are always going to be geopolitical events and a lot of other major historical events that come up, and the news will be fixated on them. And there's a lot of fear about the future and what's going to happen, et cetera. But um, overall, we'll see some reaction in the stock market. Again, maybe it's because of these events, maybe not. But the market tends to have, if anything, it has a short-term negative impact, and then in the long run, it's fine. So you can have a look at this and see what you think. But um, as far as the geopolitical events with Russia and Ukraine and Israel and Iran and stuff in the Middle East, we think that there are obviously causes for concern, both just from a humanitarian perspective and also from an investment perspective, but we don't think that this is something that we're going to be overly concerned about um, a year from now. I am noticing that COVID does not show up here on this list, which I find interesting. But that was also global pandemic that occurred in 2020, and we've since come out of that as well. So other implications. 2 weeks ago, we talked about OPEC raising oil production and that we've seen a pretty significant decline in oil prices over the past 5 months. When Israel and Iran started firing missiles, we saw a sharp increase in oil prices. But since we had already had that decline so far this year, we're kind of back to like a normal level in oil prices. So at least it hasn't been enough to have a significantly negative impact in the stock market. I had one article suggests that oil had been cheap before that attack occurred. We've also talked a little bit about the stock market trading in a range, and we would suggest that we probably will still trade in a range. We have President Trump with his tariff delay and Congress trying to pass a budget bill. And now we've got potential of U.S. involvement in this war in Israel and Iran. And they all seem to be culminating around the time of July 4th. And so I think what we're expecting from President Trump is a lot of deals, a lot of good news and announcements, and a celebration of sorts that he can come to the 4th of July holiday and say, look at everything that I've done in just 6 months in office. And we're pessimistic that he'll be able to resolve all of these by the 4th of July. Anticipate that we'll still see some delays in decisions, but that's kind of where we're at as far as what we are thinking over the next 2 weeks. We think we'll trade in a range unless we get some really good news or really bad news, right? One way or the other. We think the stock market will continue to fluctuate. A minus 0.54% for the last 2 weeks really isn't that much of a change. And so we wouldn't be surprised to see a similar change over the next 2 weeks. Finally, with this chart, this is a 5-year chart of the stock market, right? So we took the peak. If you remember back to September of 2020, we were very slowly coming out of the 2 weeks to slow the spread that really turned into many months. And we were coming off of really good news about a potential vaccine or multiple vaccines. And so we hit a peak in September of 2020. If we were to take from that point up to the peak here in February of 2025, and then this is what we call a projection channel. There's a lot of really fun stuff we can do with all these different lines, but we're essentially trying to capture about 95% of what the stock market has done over the past 5 years. And if we were to then project this out into the future, this would suggest that we've seen the stock market increase about 14% per year over the past 5 years. And we think there's a case to be made that this could continue for the next 5 years, right? I mean, we even had this decline in 2022 as interest rates went up to levels that we hadn't seen since before the financial crisis. And we still have been able to continue at this rate over the last 5 years. So yes, there are times where it's difficult, and yes, there's times where we feel like maybe it's going to be different this time, but the stock market tends to be resilient. And we are just expecting that once we can get through the issues that we're currently faced with, that there's a potential for greater things to come. If we were to project out the midline of this chart for 1 year from now, so we'll say the end of June of 2026, that would put the stock market at 6,600, which it closed just under 6,000 on Friday. So we're looking at about a 10-11% gain from where we are today is where this midline would be in 1 year. So that's kind of where we think things are going for now. Obviously, we had an uptrend through 2021, relatively flat if we were to average it out over the next, we'll call it 2 years, and then resuming an uptrend. So if we were to have an uptrend for 24 and then be flat-ish for the next 1 to 2 years and then resume the uptrend again, like we'd still be within this channel. So anyway, long story short, we're optimistic about the stock market overall. And we're not just looking to see where can we invest to try to avoid the downturn of or potential downturn from geopolitical events, but we're trying to be set up for the next 5 years. All right, as a final word, I've got pictures up here of two professional golfers, Rory McIlroy in the top left and JJ Spaun in the bottom right. These two I've been watching this year. They went head to head in a playoff round for the Players Championship in March, and Rory won by a stroke, and then he went on to win the Masters in April, which is the picture that we've got here. JJ Spaun came in this last week and won the U.S. Open, and the reason I pull these up is because it's really hard to be consistent as the best in any sport, but especially golf, where conditions will be changing daily, right? You play 4 rounds of golf, weather's always going to be different. They have you play at different times of day so that they try to balance it out and not give anybody an advantage. But it's interesting that they play tournaments all the time, but these major championships that get played that have more people in them is an opportunity for you to come out and be the best of the best. The US stock market has been the best of the best pretty consistently. So far this year, it hasn't been. There have been other areas like international markets that we have talked about in the past where we like to have some diversification. We like to have investments in other places just in the event that maybe they win one of these off tournaments. Maybe they don't win the major championship every time, but they're there for those opportunities for a win. The tournament this weekend, JJ Spaun, who he just won last week, and he's not playing super fantastic this week. And so it just goes to show that it's hard to maintain that level of greatness. But that's why we like to spread things out and then be invested for whoever might come next. So get out there and try your hand at some golf. It's really hard. I don't play as much as I probably should or used to, but it's kind of fun. I'll be out of town a little bit this week on a family reunion, and just kind of over the next couple weeks with some other vacations here and there. So reach out if you have anything that you need. Otherwise, we'll do our best to stay on top of everything while we're in the office, and we'll talk to you soon.